Derivatives are financial instruments. Their value depends on an underlying asset. This asset can be a stock, a bond, a commodity, or even an interest rate. Derivatives are used for various purposes, including hedging and speculation. Hedging means reducing risk. Speculation means trying to profit from market movements. Derivatives are important for several reasons. They provide leverage, meaning you can control a large position with a small amount of capital. This can magnify profits but also losses. Derivatives also allow for risk transfer. This means you can transfer the risk of owning an asset to someone else. Derivatives are complex instruments. Understanding their risks and how to manage them is crucial. Risk management in derivative markets involves identifying, assessing, and mitigating potential losses. This is crucial because derivatives involve leverage. Even small market movements can lead to significant gains or losses. Effective risk management helps market participants protect themselves from unforeseen events. Risk management starts with understanding the different types of risks associated with derivatives. These can be market risk, credit risk, liquidity risk, and operational risk. Once the risks are identified, appropriate strategies can be put in place to manage them. The goal of risk management is not to eliminate risk entirely. That's often impossible. Instead, it's about understanding your risk appetite and taking calculated risks. Market risk is the risk of losses due to changes in the price of the underlying asset. For example, if you buy a call option on a stock and the stock price goes down, you could lose money. Credit risk is the risk that the other party in a derivative transaction will not fulfill their obligations. This is more common in over-the-counter markets. Liquidity risk is the risk that you will not be able to exit a derivative position at a favorable price. This can happen if the market for the derivative is illiquid. Operational risk is the risk of losses due to errors, fraud, or system failures. Each type of risk requires a specific approach. Understanding these differences is key to effective risk management. There are various strategies for managing risks in derivative markets. Hedging is a common approach. It involves taking an offsetting position in a derivative to reduce the risk of an existing position. For instance, a farmer can hedge against falling crop prices by entering into a futures contract to sell their produce at a predetermined price. Diversification is another key strategy. This involves spreading your investments across different asset classes, markets, and instruments. By not putting all your eggs in one basket, you can reduce the impact of a negative event on your overall portfolio. Stop-loss orders are another tool used to manage risk. They automatically sell an asset when it hits a certain price, limiting potential losses.